JJ, the CPA here. Hope you're doing well. So for those of you that are going to get the second draw of PPP, the one thing to note is that when we're talking about the requirement that your gross receipts need to be down at least 25% in any given quarter in 2020 compared to the correlating quarter in 2019, that is based on gross receipts. Now that we are in March of 2021, we know that there are some rules that are helping the self-employed that they're able to now get PPP based on their gross income, which is different from gross receipts. So check this video out if you are wanting a little bit further definition of how to ensure that you have met a decrease in your gross receipts. But I'm also going to then show you briefly how that is different from determining your PPP loan amount, because there is a huge difference between gross receipts and gross income. So when we're talking about that, if we're now looking at a Schedule C, this would be the same for any of the other business returns when we're talking about the difference between gross receipts and we're talking about gross income. So gross receipts is just that. It's the gross receipts. It's before anything related to cost of goods sold comes out of that. Gross income is in essence after this culmination. So when you're looking at anything related to this, your best source is always going to be www.sba.gov PPP, and I'll put links to all of this. So we're going to go to this site, and as you can see, the SBA has done a wonderful job breaking this out into all the different areas. We're now talking about second draw because we want to focus in on this requirement for the 25% decrease in gross receipts. Now, we have two different applications here now. However, on both of the applications, it is the same requirement of the gross receipts reduction. So if we look at the second draw borrower application, and I'm going to go ahead and enlarge this for us, it shows us on this form down here the definition of the gross receipts. And when we're looking at gross receipts is, and it includes all the income in all forms, right? From the sale of products, services, interest, dividends, fees, commissions, reduced by allowances. Okay, so what they're indicating is that gross receipts is these items less than your returns and allowances. And this is as it references to the 25% decrease. Now, what they make clear here is that generally receipts are total income. It says in the case of a sole proprietor, gross income plus cost of goods sold. So it is not saying that you're basing your 25% on gross income. It's saying that you're taking gross income, and you have total income. They're saying for a sole proprietor, it's called gross income. Sole proprietor is Schedule C. Right at the top says sole proprietor. Okay? So for a sole proprietor, they're saying for you, you take your gross income and you're going to add whatever your cost of goods sold is to arrive at then your gross receipts, which, by the way, if we simply look at Schedule C, typically someone who has gross receipts and cost of goods sold, and if those are the only items, you're just right back to gross receipts. Possibly you're reducing down the returns and allowances. Now, that is very different than when we're talking about the gross income, because the gross income, they've given us no gray here. They've made it very clear, because everywhere that you see here, it indicates that you're using box 7 as it relates to the self-employed. So this right here is the application for those that are basing it on the net income. This is the second draw. It's still for a sole proprietor. What we were looking at is that application. There's the same application if you are a Schedule C filer right here. and you're getting it based on the gross income. So now we're going to go into that application. Reason I wanted to show you both is that the gross receipts test is the same on either application. This application is simply for the self-employed, basing it off of the gross. And you'll see that those definitions are the same here, that the gross receipts that they're indicating here, gross income plus cost of goods sold, is what you're using for the 25% test. When you're then looking at how much you're going to get on your PPP loan, it is line 7, which is everywhere, right? Line 7, right? So line 7 again up there. What's line 7? Well, line 7 is your gross income. So if I were to just sum this up, is that to determine your amount of PPP loan under the new calculation, you're taking line 7, no more than 100,000, divided by 12 times 2.5. That's the amount that you're getting for you as the owner for PPP. For draw 2, you are then determining if you qualify by analyzing your gross receipts, which your gross receipts are your line 1 minus your line 2. That's your gross receipts. Now, if somebody was wondering, well, wait a second, well, the IRS scratched that. The SBA came out and now further clarified this, that when you are then looking at this aspect for the 25% gross receipts test, as we already saw on the other application, and I already showed you here, is that it is based on this, the gross receipts, which is clearly gross income plus cost of goods sold. Gross income, line 7, determines your PPP. Gross income plus cost of goods sold determines the 25% test. So hopefully that clears it up. Might be clear as mud, but I don't think so. I think we went through it pretty good. Look at the links, go back, reread if you need to. The reason I'm going through this with you is that I want to ensure that you're applying for the proper amounts, looking at the proper amounts. So for both PPP 1, first draw, PPP 2, second draw, all in the second round, the amount that you are using to determine your PPP, if you're basing it on your gross, is gross income line 7. Draw 1 doesn't have a requirement for you to have a reduction in gross receipts. Only draw 2 does. So draw 2, when you're now looking at the gross receipts test to see if you even qualify for draw 2, you're not looking only at line 7 of Schedule C. You're looking at your gross receipts minus your returns and allowances. Or basically what it's saying, your gross income, line 7, plus cost of goods sold. More to the point, you do not base your gross receipts test solely based on line 7. Line 7 is for the amount of PPP loan, but not for the gross receipts test, because for the gross receipts test, it is a different factor as we just went through. So I'm going to put links in here for you. Hopefully that helps. Listen, do me a favor. I'd love it if you'd subscribe. I'm a practicing CPA. The videos that I'm putting together are those that are to also help my clients. In some ways, you're just listening in. So I appreciate that. All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.